I'm the Tax Geek, and here are more of your taxes oversimplified. In this video, we learned all about the most common type of IRS letter, the CP2000 Notice. IRS computers compare what is reported on every return filed to the documentation it has received on that taxpayer. If there are discrepancies between the two that will result in a significant amount of additional tax, a CP2000 notice will be generated and sent to the taxpayer. In this video, we're going to follow Monica, who received this CP2000 notice. We're going to interpret her notice and, in a later video, assist her in responding to it. So, a little backstory about Monica. Monica is a single mom with 2 children. During 2020, she faced reduced income because of COVID-19 and, as a result, withdrew $30,000 from her 401k plan. Since she had $3,000 in federal tax withheld from the distribution, she assumed, as many do incorrectly, that she had paid the taxes on the distribution and did not put it on her tax return. So, several months later, she received this rather unsettling notice in the mail. There are 2 important things to note here. 1. This notice is a proposal of additional tax. The additional tax has not yet been assessed, and this is not a bill. Second, this is a computer-generated notice. A real human being has not looked at her return. The IRS also refers to a CP2000 notice as an automated underreporter notice. The first 2 pages of the letter shows the additional amount proposed and summarizes how it was calculated. It shows the additional tax, any additional payments against that tax, any penalties, plus interest accrued from the date the tax return was due. Also on these pages is a summarized version of what she needs to do and the consequences of not doing anything. The next part of the notice recalculates Monica's taxes, first showing the increase in taxable income caused by the income Monica omitted from her return. Oftentimes, a change in income not only results in additional taxes, but it can also affect many other items on the return. In Monica's case, it didn't really affect her income tax because her child tax credit offset the additional taxes. However, she is liable for a $3,000 penalty on the early 401k withdrawal, which is then offset by the $3,000 she had withheld from the distribution. But the real damage is here. Because Monica's income increased by so much, she is no longer entitled to claim her earned income credit. Her additional child tax credit is reduced as well. Ouch. The next section of the notice lists the differences between the documents the IRS received and what Monica reported on her tax return. This list has the potential to be quite long if the IRS has several documents that don't match what is reported on the return. On Monica's notice, it shows the additional 1099-R income from Retirement Bank as well as the additional tax withholding from that distribution. The next couple of pages of the notice go into greater detail as to why the changes were made, particularly the additional tax from her missing 1099-R form, the effect the additional income has on her child tax credit, the assessment of a penalty for her early retirement account distribution, and why her earned income credit was eliminated. But wait, there's more! The IRS considers a decrease in credits as an increase in tax. As such, Monica understated her tax liability by more than 10%, so the IRS is assessing what is called a substantial understatement penalty of 20% of the understated amount. Here, the IRS is assessing interest on the additional amount from the date the tax return was due, in this case, May 17, 2021. This section of the notice tells Monica what her options are if she agrees with the finding of the notice and she can't pay right away. And the last section of the notice itself gives her additional sources of information on her notice, as well as her rights as a taxpayer. A copy of IRS Publication 1, Your Rights as a Taxpayer, is included with every CP2000 notice. Pages 6 and 7 of the notice are a 2-page response form, and the very last page of the notice consists of a payment coupon should Monica decide to agree with the changes and pay the proposed amount in full. So what are Monica's options? She can agree with the findings of the notice and either send the additional taxes using the payment coupon or apply for an installment agreement to pay off the amount owed over time. To agree with the changes, she checks the I agree with the changes box on the response form and signs it. This form is then mailed or faxed back to the IRS office where the letter originated. If she agrees with the additional amount, she doesn't have to amend her federal income tax return. The IRS will automatically change her return on their end. But she might have to amend her state return to report the additional income. Most of the time, this will result in additional state income taxes. She can disagree with the findings by checking the "I do not agree with the proposed changes" box on the back of the response form. In this case, she should not sign the form. Along with the form, she needs to send a signed statement telling the IRS why she is disagreeing with their findings and send any documentation that proves her point. That process will be detailed in an upcoming video. So what should Monica do? Agree with the findings in the letter and pay the additional amount, or should she disagree with their proposal? That question will be answered in an upcoming video. In the meantime, you can leave a comment. Should she agree or not? And why? Remember, she can only disagree with the notice if she has a valid reason for doing so. Additional details about the CP2000 notice can be found in the video description. If you found this video informative, please give it a thumbs up and subscribe for more content. Please share this video with anyone who would find it useful. You can direct any questions, comments, or suggestions to the comment space below. You can email me at taxesoversimplified@gmail.com or follow me on Twitter at TaxGeekUSA. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.